Okay, so here we're going to cover some of the important rules of personal finance and some of the rules that people follow to have some sort of financial success. And this is often some of those things that people say that they were never taught in school. Well, we're going to learn about some of the most important concepts here in this video. First thing is to create a budget and be realistic about it. So to create a budget means that you sit down and you put pencil to paper, or you might use a spreadsheet or something like that, and look at what your expenses are for a month. For a typical month, you want to see how much money you're spending on your rent or your mortgage. You want to see how much money you're spending on an electric bill, on a water bill, on a gas bill, how much money you're spending on food, how much money you're spending on restaurants, entertainment, all of those things. And if you don't know, well, you want to go back at your records and look at what you spent on those different things. You also want to make sure, of course, that you're bringing in enough money to pay for your bills for the month, for all of your expenses for the month. I say realistic about it because sometimes people don't want to basically confess to themselves about how much money they spent on in a certain area. But it's very important to be realistic about it. Otherwise, it defeats the whole purpose. Once you create a budget, you can then decide what you want to cut out of the budget. There's certain priorities that everyone has. And if you're seeing that you're spending too much money on something that you don't really care about, that might be something you want to cut out of your monthly budget. You have to ask yourself, what can you spend less on? What are your priorities? And you also, of course, want to live below your means, because if you're living above your means, then that means you don't have enough money to pay for your bills. Living below your means is about living on less than what you're bringing in so that you have money to save, so that you have money for an emergency fund, and so that you have money to invest for your future. But you really have to prioritize with a budget when you analyze your budget and ask yourself what you can do without or what cost you can minimize. Third thing is you want to have an emergency fund. You want to open a savings account maybe at a credit union, maybe open an emergency fund like a savings account using one of the online banks, as long as they're a reputable bank that's insured by FDIC. And then if you have money left over, that's where you're going to start to invest. So how do you decide how much money you should have in an emergency fund? Well, you want to have, some financial analysts say 3 to 6 months, and some say even 8 months of expenses. So if your monthly budget is $2,000 that you're spending in a month, 3 months of 3 months of savings or an emergency fund would be $6,000, right? So if you wanted to save 6 months of expenses in your emergency fund, and it's $2,000 a month, then you're talking about $12,000 in an emergency fund. If you're above that, then that's where you want to start investing. And I'll talk to you more about how to invest and how to invest through something called a mutual fund towards the end of this video, and I'll show you how that works. 4, you want to eliminate debt so you can save as much as possible. Some of the worst kinds of debts are the debts that are on high interest loans, especially if they're on depreciating assets like, for example, a car. Let's talk first about credit cards, because credit card debt is often at 16 or 17%. If you have credit card debt, you want to know exactly what you're paying, because that might motivate you even more to get out of debt. You want to know how much the interest rate is. Let's say that the interest rate on your credit card is 17%. What does 17% mean? It means for every $100 that you have in debt for the year, you're going to pay the bank back the $100 plus 17 extra dollars. So you do not want to have high interest loans, especially if it's on something like a car. Why? Because a car goes down in value. A brand new car, in its first year might lose 20 to 30% of its value. So I don't want to have a bunch of my money in assets and things like cars that are going to go down in value. We want to have our money in something that's going to go up in value instead. But bottom line is, if you have any debt that is especially at high interest loans like credit cards. You want to really prioritize getting those paid off as quickly as possible, because the quicker you pay that off, the less dollars you'll spend in interest. Nobody is becoming wealthy by giving the bank a bunch of money in interest, especially when it's at 16 or 17% interest, or maybe even higher. On a side note, maybe don't get a loan to buy a car. If you can save up and buy a car in cash, maybe a reliable, safe used car, that seems like the route to go. But again, when cars go down so quickly in value, it's hard to rationalize spending a bunch of money, especially on a brand new car. You also want to make sure that you educate yourself on how much the debt is costing you in terms of interest. You want to calculate out, how much is this interest costing me per year? How much is this interest costing me even per day? Another side note, where should you invest your money? Well, a Vanguard or Fidelity or one of these other brokerage account companies online can be very beneficial. I'll show you some mutual funds, but you should do your research. You should learn more and more. You should ask a professional also, perhaps, in terms of how to invest your money. Number 5, take advantage of all the benefits that your employer has to offer, especially a 401k plan or health insurance plan. Very often people have health insurance or dental insurance through their employer. And in my experience, it's always been, maybe not always, but usually it's been where it was a lot cheaper to get your health insurance through your employer than if you got it directly from the health insurance company themselves. So that's one benefit that many people have at their job. Another benefit that people have at their job is a 401k plan. Very often I've heard people say that they have a 401k plan at their job, but they don't know what it is. They don't know much about it. Well, let me tell you how a 401k works. A 401k plan is basically a bank account in your name that every time you get paid, you can tell your employer to put a certain percentage into your 401k bank account. And then within that bank account, you can invest that money into different mutual funds or stocks or index funds. So you can have that money invested within that account. So the benefit is it's pre-tax money. You can have it set up automatically. Every time you get paid, a certain percentage is going into that account. And then in that account, the money's being invested. If you have a really good employer, they might even say, if you put in up to 4%, we're going to match it. So you put in 4% and we're going to put in 4% also. Why would someone not take advantage of that, where their employer is just giving them extra money? Now, the downside on a 401k is that money is going to grow for you, but you can't touch the money until you're of retirement age. So again, you might want to ask questions and learn more about that, but this is a benefit that many people have at their job. If you work for a not-for-profit organization, then they might have a 403B that you can set up. A 403B is very similar to a 401k, but it's for people that are in that are working for organizations that are nonprofit organizations. Number 6, do what you can do to increase your income. If you look at your budget and you see that you're not cutting it, and you're cutting expenses, but you still end up short or a little bit short, you might want to see what you can do to increase your income. A lot of people have opportunities at their job to do extra work, to work overtime. Some people have side gigs that they take advantage of. But if you're not making enough money and you've tried to cut out some of your expenses and you've tried again to cut out some of your expenses, you might want to see what you can do to increase your income, whether that's a side gig, working overtime, or whatever it is. Number 7, plan for the future and consider the future value of your money. If you're thinking about buying something today for $1,000, for example, well, that money could be worth twice as much if you're investing it especially if you're investing it through mutual funds. So the rule of 72 helps you quickly tell how long it will take for your money to double, just as a side note here. So the rule of 72 is a very simple formula where 72 divided by the rate of return that you're getting tells you approximately how long it will take for your money to double. So if you're getting, let's say, a 10% return, that's been about the average for many investors over time. They've gotten a 10% return per year on their dollar, on their investments. If you got a 10% return, it would take you about 7.2 years for your investment of $1,000 to double to $2,000, or for your $10,000 to double to $20,000, or your $1,000,000 to double to $2 million. It would be 7.2 years if you're getting a 10% return. So it's just 72 divided by the rate of return that you're getting. So if you got a 9% return in the stock market through mutual funds or something, 72 divided by 9 gives you 8. It would be 8 years for your investment to double. Let's look at one more thing as I switch tabs here. This is Vanguard. A mutual fund is a collection of stocks that their investors, that their economists put together for investors like me and you. So this is, and I'll provide a link in the description of this video, but this is some of the funds, some of the mutual funds that Vanguard has to offer. So for example, this one here, it says Target Retirement 2040. So if someone thought they were going to retire about in the year 2040, Vanguard is saying this might be the fund for them. This is a collection of stocks and bonds that they feel is appropriate for someone that's retiring in that year. So you can see over here that since they opened this fund in 2006, this has gotten about a 7.9% rate of return as of the date of me posting this video. Over the last 10 years, this is a fund that has gotten 9.9% rate of return per year. Okay. These are all the different target retirement dates, just as an example. These are all mutual funds. Again, this is a collection. This is a group of stocks that was picked by the Vanguard investors. There's other ones. Target risk. So if someone was looking to be more of a conservative investor, this is a Life Strategy Conservative Growth Fund that has averaged 7.11% rate of return. With more conservative investors, when the market is way up, their mutual fund will probably be up too, but probably not by as much as the overall market. But when the market really takes a hit, if the market comes way down, if the stock market is way down, like it was at the start of 2020, then a conservative investor will probably lose money also, or their fund would probably dip as well, but not by as much. At least that's the idea with conservative investments. You can see here there's more than 100 different funds that Vanguard has for people to choose from. An index fund is where you just want to invest in an entire index. So for example, the S&P 500, which you often hear on the news, is 500 different companies, 500 different stocks of companies and how their stock price is doing. So if you just wanted to invest in those 500 companies, there's a way to do that also through a company like Vanguard or Fidelity by investing in what's called an index fund. I hope that you learned some things from this video. There's going to be some other follow-up videos to go into more depth about some of these important economic and personal finance topics.